Hello, everyone. My name is Steve Taishu, and I'm a Senior Director of Product Marketing here at Datasite. Thank you for joining our Energy and Power videocast. Today, we'll be featuring a trio of leaders in the energy space from Perella Weinberg Partners and its energy division, Tudor, Pickering, Holt & Company. Our speakers will be Aaron Blomquist, Partner and Head of Infrastructure, Chad Michael, Partner and Head of Upstream Investment Banking, and Kevin Cofsky, Partner, Capital Structure and Restructuring Advisory. As we all know, the global crisis has had a devastating impact on industries and businesses worldwide. However, no two industries or regions are alike, and they are all experiencing the fallout of the crisis in different ways. Today's videocast, part of our Navigating the Storm Thought Leadership series, is designed to help dealmakers think through the storms ahead and get some practical advice on how to start preparing their businesses for the restructuring wave that's about to hit. You can find additional materials on the series, as well as other energy and power content in your console. With that, I'd like to turn it over to our panel of experts from TPH. Gentlemen, welcome. Energy and power came into 2020 with no shortage of headwinds. However, in recent weeks, the sector was hit with additional blows. I'm curious for each of you, but Chad in particular, why don't we start by asking you, how have those in upstream responded to the recent events?
Sure. And first, Steve, we'd like to say thank you for having us. Kevin, Aaron, and I are pleased to be here to share some of our thoughts. As it relates to the response that our client base has had, in particular on the upstream side, to this dramatic turn of events, it has really been consistent across the board in that the response has been an immediate and aggressive move towards cutting activity. And cutting activity, it comes in a few different buckets. Cutting activity, one on the capital side, meaning that companies are reducing their rig counts and reducing their capital that is exposed to drilling for oil and gas. So cutting rig count is one. The second is cutting dividends. Our sector had just started to initiate dividends on a wholesale basis over the last few years. Those dividends are now coming under pressure, and many companies are now thinking about revisiting their dividend policy. And then lastly, our client base is also focused on right-sizing the organization to get through a period of reduced activity, and that means cutting operating costs and G&A costs. So we're seeing very immediate and aggressive responses across the board to cutting those kinds of activities.
Sure. And Aaron, I'm curious, are you seeing similar events midstream?
Yeah, we definitely are. And so think about midstream, as the name implies, we're between upstream and then ultimately the end user. So we're in the middle. So Chad's client base that he's talking about is essentially customers of the midstream companies. So, previously we were planning for some growth this year, depending on which basin you were operating in. Now we're planning more for production declines. And so what does that mean? Midstream companies are cutting CapEx. There's probably been about 15 announcements so far with some pretty material capital reductions. So, i.e., spending less on growth, less on specific projects. Number two, we've seen midstream companies cut dividends. Historically, midstream companies have paid out a large portion of their cash flow as dividends. And that's a big part of the reason why investors have liked to own these companies, because they have stable businesses and because you can own them and get a fair amount of your cash returned to you and also have the potential for growth. So there's been about a dozen dividend cuts in the midstream MLP space, and those have ranged anywhere from cutting the annual dividend by 50% to cutting the annual dividend by 90%. We have not seen any names yet cut their dividends all the way to zero. And then, something we'll probably talk about a little bit more is we're just seeing a lot of discipline around M&A, particularly using cash, but also the companies using their currency, which is traded down by in excess of 50% in most cases over the course of the last 3 to 4 weeks.
Great, and we're definitely going to come back to that point on M&A in a moment. Before we do, Kevin, I'm just curious. What are the implications of Chad's and Aaron's observations so far?
Thank you, Stephen. First of all, just want to send out my hopes and prayers for everyone who's listening. Hope you and your families are safe and healthy at this time. In the energy space, whether it's upstream or midstream or even refining, the dramatic decline in commodity prices and the volatility that we've seen has really had a dramatic impact on companies, their balance sheets, their securities prices, and the way in which they've had to not only make the changes that Chad and Aaron referred to, but really reevaluate more significant changes to the way in which they're going to operate going forward. And that has had a follow-on effect on their balance sheets and most significantly, the trading prices of their securities and potentially their liquidity. We tell our clients that the most important thing to focus on is liquidity, liquidity, liquidity. And with the retrenchment in commodity prices and as Chad mentioned, the significant reduction in capital expenditures, that obviously results in dramatically lower levels of free cash flow. That has therefore immediate impacts on banks, their view of collateral, and their willingness to continue to fund companies going forward. So we've seen a significant number of companies that are either drawing down on their revolving credit facilities to ensure that they have access to liquidity as they evaluate their next steps, or companies that are unable to draw down their revolving credit facilities and are engaging in discussions with their lenders to try to manage through this crisis, and even evaluating with the rest of their stakeholders, whether they're shareholders or bondholders, as well as their first lien lenders, how to manage through this crisis, minimize the liquidity that is being spent in ways that are not focused on maximizing and shoring up the enterprise value. So in other words, Aaron referred to dividends, but there are also interest payments that need to be made in respect of junior security holders rather than invested in the business in the form of collateral and building or maintaining value. So every company that we're talking to, again, from upstream to midstream to the refining sector, is very focused first and foremost on ensuring that all of their employees are safe and healthy. But very quickly thereafter, once they evaluate their drilling programs or the cash flow from their, as a midstream provider, what their cash flow profile looks like, they're very quickly turning toward the medium term and the longer term. If this crisis persists for a long period of time, how are they going to continue to operate and have the liquidity to do that?
Sure. Yeah, those are all good points and fascinating to delve deeper into. One question is for the group here is, what are the challenges for M&A? Again, going back to knowing that we came into 2020 being a bit of a buyer's market. We've had this unexpected turn of events. What are the challenges that you anticipate for M&A?
Sure. M&A always starts at the executive and the board level, because by definition, if a company is pursuing M&A, it's because its executives, with the support of its board, has determined that the right strategic next step is some sort of M&A transaction. In this market, companies are much more inwardly focused on the items that have been previously addressed. I will say that there are pockets of companies right now who, on a relative basis, still are strong and still do have a balance sheet that would allow for M&A. Those companies are at least allowing themselves the chance to think about the kinds of opportunistic opportunities that could be available. I would say in general, those companies are the exception versus the norm, because the implications to M&A more broadly of what's happened of late is pretty clear. M&A is going to slow down quite significantly because M&A, in a world where you have very volatile commodity prices, which we've obviously experienced, and you have a world where capital is being repriced and less available, that is going to slow down a lot of the M&A that the sector had expected to see prior to this really significant downturn. So we think the summary is that while you still have the anecdotal company that's able to to think strategically at this moment, the broader implications will be it's going to be a slower period of M&A until we can get our capital markets back to less volatility and commodity prices back to a level that support broader programs. Aaron, how does that matter up to your infrastructure world?
Yeah, no, thanks for passing it over, Chad. Look, I think when you talk about the larger midstream companies, absolutely very similar to what Chad's seeing right now. They're being very focused inwardly, focused on the balance sheet, focused on what their customers are doing. And when you think about the midstream sector, it's really a derivative of what's happening within upstream. So I'd say one difference on the asset market is in midstream, you probably did have a bit more of an active market late last year and early this year, where you did have more buyers in the space and it was a deeper market than upstream. In the last 3 to 4 weeks, you've really seen everybody go on the sidelines. And so right now we're really in a situation where midstream M&A is on pause, whether it's asset level transactions, whether it's corporate transactions. We think that's because of the inward focus. It's just very difficult to come to terms on forecast right now, and therefore very difficult to come to terms on value. And cash is absolutely kind of top of mind for everybody, being very prudent with, and so they're just really not using it for M&A right now. I would also say that just from a currency standpoint, your average midstream company from kind of 4 weeks ago to the low that we've seen in the last couple of weeks, traded down by 50% or more. And that includes the very large names and a lot of very high quality companies. And so when you see your forward trading multiple on an EBITDA basis go from 10 or 11 times to 6 or 7 times, that has implications for using your currency. It also has implications for what you're willing to pay for things. We do think that, as things stabilize, it's, really tough to say when that's going to happen. But we do think we could see activity start to ramp up in 2 to 3 months. But in the short term, we think it's on pause. In the medium term, we do think it'll get more active again. But we do think buyers are going to be very prudent as it relates to risking forecast, et cetera.
Now, I think the last point I might add to the M&A discussion is we are now in a period where most of the clients in the energy space have security prices on the equity side that have traded down significantly, but they also have bond prices that have traded down significantly. And when you have, the confluence of events that we've had combined with all securities prices being dislocated, it's very difficult to affect an M&A transaction when you have a capital structure that is suggesting material risk to the enterprise. And that's actually why, Kevin and our colleagues on that effort have been increasingly busy of late.
Yeah, Chad, thank you. That's a terrific point. And one of the ongoing challenges of any type of a corporate strategic transaction is to bring together a couple of the points that you made as well as Aaron made. Currency is obviously difficult. We talked about liquidity. And so using cash for any type of a transaction is difficult to envision in this environment. The equity currency is certainly not strong. And while the strategic rationale for transactions may be stronger today than it ever has been, because everybody appreciates the importance of leveraging overhead over a wider range of assets. When junior securities are trading at a discount, it's incredibly difficult for whether it's a financial buyer or a strategic buyer, to think about how to engage in a transaction. It's exceedingly difficult because the negotiation becomes significantly more complicated. It's not just a conversation with the existing shareholders, whether that's a sponsor or whether that's public shareholders. If bonds are trading at a material discount, they then are going to have a significant role to play in that negotiation. So it's certainly possible, and we have advised buyers and sellers of corporates and assets in the context of financial distress. It is much more complicated, and the general rule of thumb is that maximum valuation and execution is not going to be achieved in that circumstance. Better to solve your own balance sheet challenges and liquidity challenges first, and then engage in a sale transaction from a position of strength. But certainly, Stephen, it's not impossible, and it can occur, but it's more complicated, and that complication often results in a reduced realized value for sellers of assets. The last thing to just reiterate here is, and I think Aaron's exactly right, that the volatility in commodity prices and the dislocation in securities prices has made it very difficult for companies to transact. But we're seeing a lot of clients that are evaluating potential transactions. And when there's a little bit more clarity, we do think you will see a potentially significant return to transactions.
Sure, that's actually a good segue, Kevin. I'm curious, have you actually started to see the pace of liability management and restructuring pick up in energy? And what are the strategic questions companies should be thinking about or asking?
Great question, Stephen. For sure, the pace of liability management and restructuring in the energy space, as in many areas affected by coronavirus and the material retrenchment in petroleum pricing, has picked up. In fact, I don't know what adjective I could use to describe the pace of activity that wouldn't understate it. It has been almost unprecedented. I think it is at a greater level than during the financial crisis or during the tech retrenchment, or even in the late 80s, because you just have this confluence of events. And so companies are either facing imminent required liability management or restructuring transactions because liquidity is drying up, or banks are forcing transactions. If they aren't, we are encouraging our clients to be thinking proactively. If they do have time, that time is incredibly valuable, but time provides option value, and that value declines every day if you don't use it. So we encourage our clients to be well prepared to take advantage of the current environment, whether that's utilizing the liquidity that they do have to delever, or whether it's utilizing some other creative transactions if they have the ability to engage in debt for debt exchanges, debt for equity exchanges, or oftentimes more creative combinations of those types of transactions, to put their company in a position to be offensive as we start to see normalization of all of the other things that we've been talking about on this call. But absolutely, there's been an unprecedented acceleration in the pace of restructuring and liability management in all areas of energy.
Sure. That's very insights. For the whole panel, any practical advice, during this time for those who are considering restructuring? And Kevin obviously touched on a few there, but anything else that you'd add just from a practicality perspective?
I might take a shot at that, Kevin. I think taking a step back, you just think about managing a company, in particular a company that's exposed to a volatile commodity. Oil and gas pricing, energy prices are inherently volatile in any market, and so in today's market, that volatility is just more pronounced. But we do have an industry that is accustomed to dealing with volatility, and I think what we try to encourage our clients to do is to level set where we are today. Let's don't level set to where we were recently. Let's don't level set to where we are hopeful to go. Let's actually level set with where we really are today based on the information that we have today. And if a company has a good handle on its on its business plan, if a company has a good handle on its opportunity set, and if a company is in consistent, transparent engagement with its board, then ultimately, I feel like our clients will make the right decisions for all their stakeholders. And we certainly are fortunate to work with many clients who are able to pull themselves out of the immediate stress of the situation and just get very objective about what is the reality of the current playing field, and let's make decisions based on the realities of today. And I think because our sector is so volatile anyways, our executives and boards have to be pretty dynamic in general. So we just have to remind everybody, let's just double down on making decisions based on what we know today.
To Chad's point on volatility, I've heard some folks in the sector kind of joke that it feels like we've been through 5 cycles in the last 5 years. The industry's constantly changing. Oil and natural gas prices are volatile, and so you just have to plan for different types of environments. I think we haven't seen a shock like we're seeing right now. Definitely in my career, probably in most of our careers. I think I'll put it to kind of Kevin to think about kind of practical steps in advance of a restructuring, but I think it's important just to look at what some of the lessons learned are right here. I think one is from an alignment standpoint, you want your capital structure and your various owners aligned as much as possible. And it does really feel like you're aligned in a growing kind of upward environment. And when you see environments like this, that's when you sometimes, feel some misalignment in the structure. And so I think as we kind of get back to normal course at some point in the future, just think about that alignment and what that looks like in a downturn like we're experiencing right now. The second would just be, for some of the businesses, I think they just need to be managed more conservatively from a leverage standpoint. And, in the good times, you don't really think about it. Debt's been very cheap across the space for a very long time now. And so I think, as companies think through long-term leverage targets and capital structure, et cetera, try to think about something where if we do see another downturn, maybe not as severe as we're seeing now, but something maybe more similar to a couple that we've seen in the last 5 years, that you'd be in a spot where you'd be really, really comfortable. So I think it's just some more kind of long-term financial planning that we get smarter on each time we go through one of these periods.
Aaron, thanks. You've teed me up with a couple of perfect closing remarks. Look, we've been through a number of mini cycles, as you said, in the last 5 years. But the energy business is absolutely vital to the nation, and this will survive. We'll get past this. There are always actions to be taken. There are always alternatives. We don't know exactly when the market will turn. We don't know when the economy will turn, but we do know that things will improve from here. And so what we encourage our clients to do is be realistic and be pragmatic. Be prepared. As Aaron said, be prepared for a number of different potential alternatives. So we think it's incredibly important to evaluate a full range of options depending upon whether commodity prices improve, or we stay in this state for a period of time, and utilize the time that you have available and be proactive. As the time within which a company has to operate, whether that time truncates because of liquidity or covenants or the actions of third parties, other stakeholders, whether it's banks, bondholders, if you take a pragmatic approach, every company can evaluate the time frame within which it has to make decisions and transact. We therefore think it's incredibly important to do that. Again, be realistic and then be proactive. Engage with stakeholders to try to find win-win outcomes. Those are not always achievable, but one thing that we know for sure from experience, if you don't engage with counterparties, you can't find solutions. And if you wait too long, the alternatives that you have available to you become more limited. And the opportunity to engage in creative solutions become more limited. So if I could sum it up and leave folks with one thought, it's be realistic and proactive as you evaluate what to do in this very challenging environment.
It's great feedback, great advice, Kevin. Kind of that theme of just engaging early, being realistic, being pragmatic, engaging your advisors early seems to be a common thread across sectors. No surprise there. But I think to your point, that last point around the longer you delay engaging is the less creative and the fewer options you may have on the table. So great insights. Gentlemen, it's hard to believe it is kind of the tail end of our call, but any final thoughts before we close? Anything else you'd like to add before we end the call today?
I might just close by by saying that right now we're all in a very difficult period of time for our country, for our family members, for our coworkers. And so I echo Kevin's point from earlier. We really do hope everyone is staying as healthy as they can, and we are all in this current environment together. I would say that the energy sector right now is really on its heels. And what I think are most impressed by with our client is while the pace of this downturn has been faster than anybody could have expected, the response to this downturn as it relates to immediate action and very difficult decisions by our clients, has been something that we take note of and we know is not easy. And then lastly, we do think that a strong energy sector is vital to our economy and to our nation, and for a whole host of reasons, we're all committed to helping this sector weather this difficult period. But we certainly expect it to have brighter and stronger days as we all work through this together.
Great, thank you. All right, well, Aaron, Chad, Kevin, thank you all for participating today. It's been great to hear from leaders like you in the space, especially as we continue through these uncertain times. To our listeners, that's all for today. However, we will certainly be continuing the conversation with others in the energy and power space in the weeks ahead, and we hope to have our panelists participate in those conversations as well. So again, thanks everyone for joining, and we'll meet again.